Thanks. So since March of 2020, we saw a lot of success stories involving the market as a whole. However, compared to the S&P 500, their 18% gain, 60% of large cap stock picking funds in the US underperformed. So this is actually the 11th year in a row that stock pickers ended up doing worse than the market. And you might question how this is possible, seeing as almost everything was rebounding since March of last year. And a lot of these S&P 500 gains came from large tech companies. So Amazon and Apple specifically, they're up 76% and 81% respectively since last year. And these two companies make up more than 10% of the S&P. And most stock pickers don't really have the means to buy enough of these companies to make that big of an impact. And so in general, different funds had a wide array of returns. American funds, they have a fund called Growth Fund of America, and that fund returned 38%, which outperformed the S&P by more than double. And active managers dealing with mid-cap stocks had an average return of 51%, and those involved in small cap were closer to 46%. And some believe that these gains are easier to come by on these smaller stocks as they aren't analyzed as thoroughly as these big name companies. And the biggest winners from last year were large cap growth funds, who were up 62%, and large cap value funds, who ended the year with 67% gains. So by the end of 2019, $6.6 trillion was being actively managed, while only $4.4 trillion was being passively managed within the index. And so we should look to see how this allocation changes after a lot of active managers failed to beat the market in a year that had a lot of opportunities. And if you want to hear more about active versus passive managed funds, be sure to check out the podcast because we touch on that.